point it out to. Or I think it's not working some way. Okay. So the first part of the presentation is dealing with the ECL approach for the banks and the financial institutions. The second part is on the ECL or the new impairment model for non-financial sector entities. And we'll also touch on the major hot issue nowadays, how the new impairment model is going to affect the circular debt problems that we have, how the expected credit loss model will be applied to the situations of long overdue receivables from the government sitting in the various public sector entities. So starting from the, I hope it works, otherwise. Achale, okay. So, okay, in the meantime, I can give you some background about the incurred loss and the new expected credit loss model. So it all started from the 10 years back from now, from the financial crisis time, 2008, when it was felt that the accounting fundamental principle of recognizing losses when incurred is something which needs to be challenged. For the simple reason that the accounting, as we all are accountants, and one of the basic principles we have learned in accounting is that transactions and events are accounted for when they are incurred. So the accounting systems capture transaction and events on an incurred basis. And this is one of the fundamental conceptual principle that is still in the IFRS books. But this principle was challenged during the financial crisis in 2008 when it was felt that the banks and financial institutions particularly should look forward and should account for the expected credit losses also, not only on the incurred loss basis. So that there are entities like banks and financial institutions with inherent risk of incurring certain credit losses by the nature of financial instruments that they originate, like loans and receivables, and it is inherent in their nature of business that they incur certain loss. So why to wait for the time that the loss incurs? And therefore, the current model that we use is whenever there is an objective evidence of impairment, whenever the loss event arises, we start booking the loss on a historical experience basis. So in Pakistan, as you all are aware, under the prudential regulations, the loan losses are booked based on a mechanical formula, based on an age-based system, where loans which are overdue by a certain number of days are provided for on the basis of a certain agreed percentages. Now that is a mechanical way of looking at a loan loss provision, which is on an incurred loss basis because the overdue status of a loan is considered as an objective evidence of its impairment. Now this particular way of doing impairment was criticized during the financial crisis, and it was felt that it results in the delayed recognition of loan losses, because what happens is, in good times, the banks originate loan books and the loan books expand. You recognize income, interest income over certain years, in the initial years when you're expanding the loan book. And after 2-3 years, the credit losses begin to surface, and at that time, the institutions have to book those losses on an urgent basis, which results or creates some crisis in times of economic downturns. Now that should be envisaged from the very first day when you book or originate a loan. And therefore, the loan loss provision should not be made on an incurred loss basis, but also on an expected loss basis. This is the conceptual principle which was set in a financial stability board and other accounting standard setting bodies. And by the way, because I've dealt with many of the banks during the last 1.5 years in IFRS 9 studies, but I think one of the comments that were made is that these standards are created by accountants to generate more work. But to tell you the truth, I think the new IFRS 9, there are a lot of contribution of the banking regulators around the world, because the concept of prudence have been stretched to an extent that the expectation of credit loss or expectation of losses has to be accounted for in the current period, which potentially would result in a higher amount of losses to be recognized currently as compared to the regime that we have of incurred loss model. So there's a lot of contribution of the banking regulators and prudential regulators around the world in making of this standard. And that's the reason why this standard is in some cases create challenges for the accountants, because it contradicts with the very basic principle of accounting that losses are recognized on an incurred basis. We do not recognize future profits. We do not recognize future losses. Imagine a company, a manufacturing company. Do you suggest a company to recognize future losses, howsoever they're expected? You will not allow those losses to be recognized in the current time, whether or not it's prudent or any other principle. So this is by its very nature is somehow contradictory to the fundamentals of accounting. But this was challenged, as I said, that in the case of banks and financial institutions, it's very difficult to say that you will not have any credit loss, because it's inherent in the nature. On a portfolio, you will have some credit loss at some point in time, and therefore there should be a mechanism to predict those expectations of losses and account for it now when you're entering into the arrangements. So this approach is forward-looking as compared to the backward-looking approach that we follow today. But whenever you apply any forward-looking approach, it is loaded with those challenges, because it's not difficult, it's not easy to predict the future. To predict the future, you have to make lots of assumptions. You have to study the history. Then you have to account for various factors that you expect to happen in the future. So you have a history which is used as a basis to predict the future, and plus some futuristic factors needs to be considered to make your estimates forward-looking. By its nature, this process is very, very complex. But there are certain principles which are set out in the standards to make that process helpful for you. Now, what I mean by expected credit loss is that the loans, imagine a loan portfolio, and when a loan portfolio of a bank or any other financial institution where you are accounting for losses on expected credit loss basis, you can have different scenarios. And scenarios based on cash flows. You can have scenarios. In one scenario, where you will be able to realize all your contractual cash flows. In the other scenarios, you will be able to realize only part of your cash flows. Or there may be a scenario where virtually you will not be able to realize any of the cash flows. But what scenario is how much probable is a matter of judgment. So you can have different scenarios, and based on those scenarios, you build expectations in order to determine the expected credit loss model. But it is not practical to follow this approach on a loan-by-loan basis, because hundreds or thousands of loans sitting in a portfolio, it is not possible to practically apply that methodology and have cash flow estimates on different scenarios, apply probabilities, and come to an expectation of credit loss which should be accounted for on a present value basis today. So therefore, the IFRS 9 is suggesting an approach which is in line with the business model of a bank or a financial institution. What IFRS 9 is suggesting is that any bank would have mechanisms to track the credit risks. When you originate a relationship, you know how much credit risk you are accepting. And as you go along, the credit risk either increases or decreases on that loan. And there are mechanisms to capture the increase or decrease in the credit risk Normally, all banks have credit rating systems, internal credit rating systems. In some cases, they also use external credit rating systems where they score different loans based on their credit characteristics. And as a result, they quantify the amount of credit risk at the start of the relationship, and they also keep tracking that credit risk as they move in the relationship over a number of years. So there are mechanisms with financial institutions to track the amount of credit risk. So all loans are not equal. When all loans are not equal, for instance, the loans that you have originated today have a low amount of credit risk because you think they are high quality, carrying low credit risk. The loans you had originated, say, 3 years back, their credit risk may have increased because the time you originated that loan, you anticipated the companies to perform in a particular direction. The economics have not worked that way. The businesses have not worked that way. There are situations which were not envisaged at the time of credit loan origination, and therefore the credit risk has increased on that loan. And therefore, for those loans, the expectation of credit loss is more than the expectation of credit loss on the loans that you have originated recently. So these situations are accounted for in the IFRS 9 model. And therefore, what IFRS 9 is saying, that you divide your entire loan book into 3 buckets, which we call stage 1, stage 2, and stage 3 bucket. Stage 1 are the high quality, low credit risk loans with high internal credit risk ratings normally, which are originated recently. They are good loans, well performing, and they are stage 1 loans. Typically those loans which have recently been originated. Stage 2 loans are those loans where the credit risk from the date of the origination has increased. So those loans, and there are ways to measure the increase in credit risk where there is a significant increase in credit risk. In a moment I'll come to a slide where I'll explain what is involved in measuring the significant increase in credit risk. But stage 2 are the loans where the credit risk is considered as increased as compared to the credit risk which was considered at the time of the origination of the loan. And the stage 3 are the loans which we normally refer to as the non-performing loans on impaired portfolio, which are already, for which there is already an objective evidence of impairment, and the defaults normally have taken place or have occurred. So stage 1 is stage 2 and stage 2 loans. Stage 1, the level of provision on stage 1 loan is low as compared to the level of provision on stage 2 loans. Why? Because on stage 1 loans, the IFRS 9 requires that you make your provisions on the basis of only 1 year expectation of credit loss. So the chances of loss event occurring in the next 12 months, how much credit loss you expect to incur because of that event is accounted for as in stage 1 loans, which we call 12 months ECL or 12 months expected credit loss. Whereas in stage 2 loans, IFRS 9 requires the lifetime expected credit loss has to be accounted for. So, which means that chances of default occurring over the life of the loan has to be accounted for in the estimates of expected credit loss. So naturally, the level of provision in stage 2 loan is much higher as compared to the stage 1 loans. And stage 3 are the loans where the level of provision is much more higher because the losses have already occurred and the event of default has already happened. So what we do is that in terms of dividing the portfolio in stage 1, stage 2, and stage 3, we look at various factors that when is the time a loan is considered to have increased credit risk. Now, these are the factors which are considered. For example, you look at the change in the credit rating. In most of the banks, the credit rating systems are present. So whenever you have a downgrade in the credit rating, 2 notches or 3 notches, that is an indication that the credit risk on that loan has increased. When there is a downgrade in the external credit rating, if the loans are externally rated as well, which is rare in most of the cases, then in that case only the credit risk is expected to increase. There are factors, for example, there is a there are operational issues with the performance of the company that you have given loan to. If that has changed and is indicative of the increase in credit risk, then also you can consider that the credit risk has increased in the stage 2 loan. But all of these factors, the change in credit risk, change in operational conditions, financial performance, etc., industry factors, these are all normally considered in rating a loan. So they are all capsuled in the credit rating that you assign to a loan, because the scoring systems that normally banks use consider various financial quantitative factors and various qualitative factors as well. So a composite credit rating is assigned after considering all these factors, which normally represent a view whether the credit risk has increased or decreased over a loan. So we can take a credit rating as a measure to determine whether the credit risk has increased or decreased on a loan. Standard also provides a presumption that for all loans where any installment of loan has passed due by 30 days, so the DPD status or overdue status of a loan has passed 30 days, it is assumed that the loan is a stage 2 loan and the credit risk on that loan has increased significantly. Now, this assumption can be rebutted as well, because we all know in Pakistan's situation, it is a normal tendency that the loan installments are paid not only by 30 days, after 30 days, but by normally on 89th day or something, to take advantage of the prudential regulation window that is available, because the loans are considered impaired after past due of 90 days. So there is a administrative or kind of a habitual issue with the borrowers, where the loan installments are paid normally with a delay of 60 to 90 days. That necessarily is not an indication that the credit risk on the loan has increased, because this is an operational and administrative issue. And therefore, if you have a history to prove that in most of the cases where the loans have passed 30 days or 60 days, they have not eventually gone into default, then it is you can rebut this assumption by saying that 30 days overdue is not necessarily an indicative of an increased credit risk on a loan, but you have to demonstrate it with a history in your specific situations. So normally speaking, you monitor all these factors on a continuous basis through the credit risk rating mechanisms, obligor risk rating mechanisms, and then determine whether the loan risk has increased or not. So increase in risk means the increased level of provision that you have to make in terms of the expected credit loss on that particular portfolio of loans. So that's why it's so important to be very clear that which loans carry a higher risk as compared to the loans which carry a low risk. The stage 3 loan, as I say, now come to the heart of the standard, which is, okay, you've decided that what portfolio is stage 1, stage 2, and stage 3. And you've also decided the loans which require a lifetime expectation of credit loss in making a provision, and loans which require only a 12 months expectation. But how to measure the expected credit loss? How to determine what methodologies to use so that those estimates are made in a manner which are objective? There are 3 principles which are laid out in the standard. The standard is not prescriptive, and the standard is not prescribing any methodology to be used for computation of ECL. The standard is principle driven. The 3 principles are that it should be on the basis of historical and forward-looking information. So you should study history, your historical loss experiences, and you should also look at the futuristic factors like macro